You've probably seen the headline floating around your feed recently: a 13-year-old kid turning a tiny $80 investment into $30,000. When you look at the sheer speed of the crypto meme coin market, where new digital tokens are multiplying and shooting upward in seconds, these viral success stories seem totally plausible to the average investor. But the statistical reality is far less glamorous. The vast majority of users trying to ride these hype waves end up losing their entire investment to carefully orchestrated scams. Today, we are going to look under the hood and expose the exact tools scammers use to manufacture fake volume. Then, we will walk through the disciplined option selling strategies professionals use instead. True wealth in the crypto market rarely comes from getting lucky on a random coin. It comes from exploiting the predictable behavior of the speculators themselves. To understand the trap, we need to look at platforms like Pump.fun. Here, the scale of coin creation is overwhelming, with brand new meme coins launching every few seconds. This daily candle chart visualizes the typical life cycle of a hype coin. We see a massive parabolic green price spike, sometimes reaching 400,000% returns, that instantly reverses into a devastating 80% red drop. This specific pattern is a mathematical trap. It lures retail investors into buying at the absolute peak, injecting real liquidity into the market right before the floor falls out and the coin crashes. The secret behind this manipulation is a back-end web application called CoinTool, or CT.app. Taking a look at the CT.app dashboard, you can see a specific pump, launch, and buy module. This tool systematically generates dozens of fake wallet addresses at the push of a button. Once created, these automated bot wallets start trading the newly launched coin back and forth with each other. This simulates massive market volume, tricking outside observers into thinking a real rally is happening. The momentum you see on the front end is an illusion. The perceived hype is mathematically engineered to steal real capital using fake volume. So if the meme coin market is a rigged casino, the professional alternative is stepping off the casino floor entirely and moving to a platform like Delta Exchange to sell options. Option selling relies on a completely different philosophy. Instead of hoping a coin surges 400,000%, you construct trades designed to profit from a market that stays stable or even moves slightly sideways. The engine driving this strategy is implied volatility. When markets are chaotic, implied volatility spikes, which artificially inflates the upfront premium prices of options contracts. This line graph maps out how time decay works in your favor. Notice the stable, sideways market trend line and watch the descending curve above it. That curve represents an options premium slowly decaying down to zero as time passes. As an option seller, you collect the inflated premium up front. If the market stabilizes and the option expires without hitting its target, that premium stays in your account as pure realized income. Gamblers place bets on unpredictable, massive directional spikes. Professionals build systems to capture value as time passes and volatility collapses.
Let's set up a specific strategy. We start by selecting out-of-the-money call and put options, meaning we pick price targets far away from where the asset is currently trading. Looking at this order history interface, we've executed a live setup, selling a $93,000 put and a $96,000 call. You'll also notice a very specific 5:30 p.m. expiry timer. That daily 5:30 p.m. expiry is your finish line. If the price of Bitcoin stays anywhere between $93,000 and $96,000 when that clock hits zero, you keep 100% of the premium you collected. To make this capital efficient, professionals use leverage. Rather than viewing leverage as a lottery ticket to multiply a gamble, they use it as a tool to control a defined position with less upfront cash. By utilizing up to 200x leverage, you can control this specific wide bracket position by putting down roughly $500 in margin. The return on that $500 margin becomes highly attractive. In this setup, as the option prices drop from $13 down to zero at expiry, that exact margin yields a clear $447 profit. This payoff chart illustrates exactly why this works. You have a clear, wide profit zone safely bracketed between your upper $96,000 call and your lower $93,000 put. As long as the price lands in this valley, you win. Applied with discipline, leverage magnifies your capital efficiency. It turns a flat, uneventful trading day into highly lucrative, structured returns. There is, however, a severe risk to the setup we just built. If a sudden, massive market crash or unexpected spike breaks through your upper or lower boundaries, an unhedged position can drain your account. To survive long-term, professionals use a mandatory countermeasure, hedging the portfolio to strictly cap any potential downside. In options trading, building this specific structural hedge is called an iron condor. This chart displays an iron condor payoff profile. To build this, you buy even further out-of-the-money options to act as an insurance policy against the positions you just sold. Notice the flat lines on the extreme left and right. Those represent your strictly capped maximum loss zones. By purchasing these outer wings, you transform a potentially limitless loss into a strictly defined risk. If the market goes completely crazy, your insurance kicks in. The hallmark of professional trading is mathematically defining and capping your downside before you ever enter the market. We started by looking at how retail investors get drained by fake volume bots and mapped out a concrete alternative, generating consistent daily income by selling options. Entering this professional ecosystem is highly accessible. Platforms like Delta Exchange India allow you to deposit funds instantly using UPI. They also offer a financial stability mechanism, a flat 85 rupee conversion rate for both deposits and withdrawals, eliminating the frustrating friction of volatile forex rates. To leave the casino behind and start trading systematically, use the link in the description to open your account and subscribe to USFINOX for more advanced strategy breakdowns. Before you go, drop a comment below and share the strike prices you are eyeing for your first trade. See you in the next one.